Well, thanks for joining us today, everybody. We are chatting today with our co-host Chase Hodgson on the lending side in regards to some of the upcoming anticipated Federal Reserve cut. And really what we want to kind of get our head around is, should you be looking to buy in 25, late 25, 26? Just try to get ahead of that so that nobody is disappointed in the decision they make. We're just trying to provide value in the way of providing kind of our thoughts and opinions and generally what we see, and hopefully help you make a good decision. So we're just going to kind of logically progress through the list of the agenda that I have here. So with that, I'll bring Chase Hodgson on. Chase is a better part of a 10-year appraiser and a good decade into the lending side of things. So we really appreciate, specifically on this topic, I think you're really going to bring a lot to the table that the viewers and listeners will appreciate.
I hope so.
Yeah, thanks for putting it together. This is Chase's agenda, so we'll cover some ground here. But yeah, thanks for hopping on. Let me just do a couple of small housekeeping items here real quick. For
Yeah.
those of you that I haven't met, my name is Jerod Lee. I'm the associate broker and team lead at My Home Connection, also known as MHC Realty. Our sponsor for today is the perfect home buying process. We've been developing this over the last couple of decades to help make your home buying process seamless, painless, and hopefully least expensive as possible. We're currently offering a up to $500 appraisal on the downstream purchase of your next home through Summit Funding and Chase. And then I'll help with the up to $500 on the home inspection to make sure you're getting a home in good condition. And then we've just put a lot of things together over the years. We want to share some industry secrets with you, a podcast series to help answer any as many questions as we possibly can, and just the other items that you see here. So if you would like to have a no obligation consultation, we'd love to see how we can help you out specifically with your needs. But other than that, we'll bring Chase on. So we'll just set the stage. What's your thoughts on kind of how we've gotten here with the Federal Reserve?
Oh, man, it's interesting. Historically, and you and I've talked about this quite a bit, but historically, they are slow to act in either direction, right?
Hmm.
Over careful, don't want to overheat or overcool the economy.
Cautious,
Um,
yeah.
yeah, overly so. So it takes typically longer for slowdowns to happen, and it takes longer for things to pick back up because of the way they move. And this time, especially, I think all the other countries have already moved for their central bank, cuts, and so we're kind of the last one of the ball game. And I think there's a lot of factors that go into that. All the stuff that's happening internationally, all the stuff that with the tariffs and stuff. I think they were probably trying to wait to see how that affected things, and so going into this last, to their meeting in Jackson Hole, the markets basically priced in the day before the fact that they feel comfortable that the Fed is going to, do some kind of a funds rate reduction in the
Yeah.
in the September meeting.
Yeah. I would imagine, as you were talking, that it makes sense to be slightly delayed because our economy does affect so much of the world that, you know, if other countries misstep, it affects them and maybe others, but the US is going to have, an order of magnitude or more effect on the rest of the world.
Yeah, yeah. I mean, you definitely want to be careful. There's, and we'll get into it here, but there's like it's never an immediate effect, right? The things that like they can make changes. There's things that they can do, and the funds rate cut is just one tool that they have. There's a lot of tools that they can use with monetary policy. When rates were so low, right? Buying and selling themselves, treasuries and so there's a lot of things that they can do that'll affect it. But when they do that, it takes a while to filter down through the economy and see how much it's actually going to move the needle.
Yeah, so if
And
you're yo-yoing, making a quick decision, and then you see it
right,
starting to affect the economy, realize it wasn't the correct adjustment. Now you're bouncing it back, and yeah, if you
Yeah.
don't move slow, then you probably get that yo-yo effect and be frustrating people.
Yeah. Yeah. And I'm all for it. I think there is definitely too slow. Um,
Well, and we've had the whole, we won't get into the politics side of things, but this last year is
yeah.
people have
I'm a, I am definitely, I'm a market guy, right? Like, I studied economics in college. That's what my degree's in. Um, and I think the more we let the market regulate itself, the better off we are.
mm,
Um, Supply and demand is are great tools in the market, and letting people make those decisions
uh,
when the human factor gets in trying to guess what the market's going to do and what people are going to do. I
yeah,
think we get into more trouble.
yeah. Well, let me ask you this. I think if we just took everything that we're talking about today and summarized it to, is it helpful to hyper analyze where things are going, where it's been, where it's at and where it's going, or from a home buying process, right? Because that's the crux. That's going to be the last question we're going to ask. Does it make sense to buy today or not? I, what's your thoughts on if that's a valuable exercise for most, or if it's just really what we've talked about before? If you're ready to buy, then buy, and you know values are going to go up over time. That's been proven historically. Anyway, what's your thoughts?
Yeah, I don't think we should overanalyze. If it's the right time for you, then you should buy, right? Like, because you can analyze it to death, and you've got experts in the market that are always trying to time it. You can't. People, it's luck if they time the exact top and the exact bottom, right?
Right.
Like and we both work with investors that try to do that. Like, the good investors just buy, right?
Yeah.
If it's right for them, then they make their move. And I think that's the way you have to act. Over time, real estate just keeps continuing to go up. Even if we've talked about this before, even through '08, right? Like,
Yeah.
that's so typically in a recession, um, real estate values don't go down, right? The typical is to flat line or just increase slightly. And historically, you can go back and look through all the recessions. I think there's been two since the 40s where real estate values actually went down. '08 being the only one that was significant, and that was significant. So it was difficult through, from '08 to 12. But once things started to come back again, then there were massive gains for the people
Yeah.
um, that either bought or sold or held through that time.
Yeah.
So over time, I mean, if you think of it more as a long-term investment instead of trying to, to gain equity instantly, like we were able to see, through, the COVID years, then you will be fine.
Yeah. I think that's a good example, right? If you were frustrated that you bought at the peak in '06 and '07, and you're mad because the market crashed and your values, depreciated significantly. Uh, but you held it, you made out well, right? I
Yeah,
mean, you really well, not only tens of thousands of dollars, but hundreds of thousands of dollars, depending on what you bought and when you bought it.
yeah,
So, so it's I didn't want to buy at the peak, but I did. Yes, it crashed, but I held on to it, but then it recovered. That's a perfect example of why it never. I mean, yes, it would have been better to buy in 10, 11, or 12 than in '07, and you would have made more money, but you still made out well if you held on into the 2020s.
yeah. And it's tough, right? Like that. Like, so, my advice to home buyers would be more of what are your personal plans, right? What
Mm-hmm.
is your plan for you and your family?
Yeah.
Are you staying put for a while? If you're going to have to move in 2 years, then you have to be a little more critical about what the market's doing,
Yeah.
right? So, and
Right.
that's kind of how I would approach it.
Yeah. That's usually my first question is, are you likely to move because of your job or just want to be in another area? Are you going to have major life events in the short, maybe midterm? Are you going to, have more
Right.
kids, or, are you going to lose a family member or need to bring a family member into the house? You know, then you're right. Don't get in because there's cost to get back out. But generally speaking, people are going to get in a house and stay, for long enough that, you know, even if there's a downturn in the market, which nobody perceives there's going to be another crash like '08,
Hmm.
you're going to recover. It might just mean you have to hold on to your home a little longer than what
Right.
you originally thought, right?
Right. And there's a yeah, and if things come up, surprises come up, there's always other ways to try and
Yeah, mitigate it.
there's good rental or an investment property or something like that. There's typically there's options.
Hmm.
But yeah, like if you're not doing any, if you don't have to worry about anything immediately, then you don't have to be nearly as critical to the market.
Yeah. So correct me if I'm wrong, Chase. We're expecting the Feds to cut rate next month.
Yeah, and let's. I know we've talked about this 100 times, but let's dive into it really
Yes.
quickly as as you're going over that. So the Fed is they've left the door open. They didn't say they were going to cut, which is what they always do, right?
Right.
They have a lot of they can affect the market by talking,
Yep.
right? Just by what they announce or what they say or don't say
Yeah.
affect the market, right?
People make decisions.
Right, and here's why, right? Because when they say they're going to cut the overnight Fed funds rate, which is the rate at which banks lend money to each other, right? That doesn't it's not a one for one with mortgage rates, right?
Right. Right.
So what that does is it affects the yields between the mortgage-backed securities and the Treasury. Okay, so if they cut the funds rate, then consumer like the what it'll affect directly is consumer debt, right? Direct to consumer, whether that's car loans, credit card rates, those kinds of things.
Yeah.
Now it has a an effect on mortgage rates in that so there and this you've probably heard me say this 100 times and hate it, but there's I heard once that there's only one thing that affects mortgage rates, and that's mortgage-backed securities. But unfortunately, everything affects mortgage-backed securities, right? And so that's kind of the way. And so a way to look at it is the Fed cuts the funds rate, and then there's lag, and then we see how that affects the bond market and the treasuries market, and then that again will affect mortgage rates, right? As the mortgage-backed securities market goes up, right, and it affects those yields, and those yields increase, then you're going to see mortgage rates go down.
So if I can oversimplify uh, for those kind of non-analytical folk, would it be as simple as saying when the Federal Reserves make a cut, uh, it is indicating a trend, a potential trend in the short term of mortgage interest rates in the direction that they modified up or down, and there isn't a direct one-to-one correlation. Is that
Yeah, and it's a tougher conversation now because like during COVID and stuff, like the bond market and the treasuries don't move in lockstep, right? They move opposites, but they were moving together, they were moving separate, like so there's a lot of, and that's the key, is there's still a lot of things that can affect it outside of, right? This is one tool that they have. This is one small piece that can affect mortgage rates.
Yeah. Well, let's talk about a specific buyer that's in the market, kind of looking around. Do I buy? Do I not buy? And if I hear the Feds are going to cut rate, uh, I would say the it's fairly likely that your interest rate is going to get better as you get deeper into the buying process. And when you help them lock their rate, it's probably going to be more promising than
Yeah.
when
Well,
they just start talking about it.
yeah, and it's also, and I don't know if I can have this conversation simply in a short period of time, but it's also, like if they come out and say, "Oh, we're going to cut the funds rate half a point," right? That's a big move. Does
Hmm.
that mean interest rates go from 6.5 to 6? Absolutely not, right? Like that's the thing. So if you look at mortgage rates, um, it's you know it's incremental movements,
Hmm.
right? So they move the funds rate at 0.5%. The treasury yields go down, and mortgage-backed securities go up, and then, but this is all like, there's so many other factors that go into those markets, and then we see that betterment in interest rate. But
Yeah.
it's incremental. A good example was, it would be like, so if par meaning there is no discount or no cost for an interest rate, is 6.5, you might be able to go to 6.375 for 0.5% cost, right?
You're
It doesn't.
bringing to the table that money to make up the difference.
Right, yeah. So it could reduce the cost of an, or if you're at 6.5% and you're paying half a percent in discount point, maybe that goes to you're paying 0.25% in a discount point, right? Like, they're incremental movements,
Mm-hmm.
and it takes time for them to, for that to become significant to the average home buyer.
Yeah, but for the takeaway, the simplest takeaway would be put that in your hands. Get with you, see what you
Mhm.
qualify for at what things look like today, and you're going to monitor whether it's moving in a positive direction for the buyer or not. If it looks like it's going to trend up in interest rate, then you're either going to lose buying power, you're buying at a lower price point, or you're potentially buying the same price if the interest rates go down for a better monthly mortgage, or your buying power goes up. So I'm just saying all these things. Oh, God bless you.
Thank you.
Are things that they can just rely on you. Where do we sit
Yeah.
today? Yesterday you told me I could buy a $500,000 home. We're out looking. I heard the rates are changing. What's your thoughts in a week or two? It's like, well, if it moves in the direction we think it should, your buying power might go up to where you wanted to be at that home you looked at 2 weeks ago that we didn't think we could afford.
Yeah, yeah. I think the easiest way for me to summarize it is, if they cut the funds rate, that there's a chance that will lower treasury yields, which will lower mortgage rates. But in between there's a whole bunch of lag and a whole
Yeah.
bunch of noise that can
Yeah.
affect it, right?
Yeah.
So
That's
it's,
your job. Yeah.
yeah, yeah. And so let me handle that. And throughout the process of buying a home, from the time that you go under contract to the time that we need to lock or close, it can move, right? It can go up or down. And so that's why you talk to a professional, so that they can advise you when's the best time to get the best interest rate for you during
Yeah.
this purchase.
Yeah. Yeah. And we'll just interject one important thing to note here is if you fixate too much on the rate and everybody's perception is over time it's going to go down, um, you might shoot yourself in the foot
Yeah,
because you can, the price that you buy the home is not adjustable. It's going to be whatever's in the purchase and sale agreement and whatever you close on it at. But the rate can be revisited later through a refinance, not a free event, but uh, back to you helping them gauge whether it makes sense for them to spend money on that and adjust their rate such that their
yeah.
mortgage is less.
Yeah, and it's not something that everybody wants to do. Everybody thinks, oh, that's just a way for the lender to get a couple different, get you a couple different times, and that's not the case, right? Like, if it's right for you, it's right to buy now. It's right for you to buy now,
Well, that's an
and
easy number, right? You can put that in a
right,
calculator.
and there's a trade off, right? There is a trade off, especially right now. I think, and we talked about this before, with all availability of, we're at the best inventory that we've had in a while, in quite some time, right? The higher interest rates have slowed purchases. The low interest rates that people locked in have slowed relisting, right, on
Mm-hmm.
resale. Um, and so, I mean, if you look at it like this, right? So I think the NAR numbers, and you can correct me if I'm wrong. The NAR numbers are, for I think what they said was, if rates go from 7 to 6, that's 5.5 million new borrowers that are able to enter the market.
Okay, let's fixate on that number
Mhm.
for a minute because that's an
That's
important number.
nationally. Yeah.
Yeah. So yeah, nationally across the country. Say that again. If we go from 7 to 6.
Yes. 5.5 million new borrowers that can now afford to buy.
Okay, that's a big number, but that's also a big effect on our market. You
Yes.
you have a low inventory nationally. You have low inventory in the valley here for sure because we've been historically low. We just can't keep up with demand. So
Right.
we've already got people hovering. We know it, right? We see our online listings with a lot of views. We're not seeing them come through the property yet, but we know they're out there looking, right? They're
Yep.
just waiting, just like every other buyer, right? Is the rates going to go down? Is the price going to go down? Are the wars going to end? And then now I'm going to pounce. Okay. So 1 point from 7 to 6, 5.5 million new buyers.
And here's the scary part. We're halfway there. Like realistically, you know what I mean, rates, you're a lot of the rates we're seeing are 6.25, 6.5, depending on whether you're going government or, conventional or person or primary or purchasing a primary or an investment. But yeah, like average, we're about halfway there.
Yeah. Yeah. So, I hopefully our listeners, watchers can kind of fast forward. What happens when demand picks up and inventory is already low?
Sales could, they're, I think in that same article, they were saying sales could increase a minimum of 14% when that happened.
The
And that's a
values,
national number. No, no, the
the
just
sales across the
just
country.
the sales across the country of homes, right?
Yeah.
And so you try to look at that and apply it to our market directly, who typically is higher than the average anyway.
Yeah.
I mean, this inventory that we've been able to build up a little bit during the slower period of time, boom, now that gets eaten up. And then, you know, supply and demand, like that's it's what I always go back to, through economics, because it's the easiest way to qualify what's happening is as your supply decrease, your demand goes up, your supply decreases, what happens to price?
Yeah. It's like kind of gravity. Like some rules are just immutable,
Yep.
right? Supply and demand always works. Um, and I want to interject real quick. An important thing to note is please be aware of the national conversation on media about real estate that
Mm-hmm.
may or may not be applicable to your macro market may not be in that discussion may not be applicable to your micro market. I mean, generalizations are generalizations, but when you say, hey, the real estate market's doing this, your micro market, your local area might be doing something drastically different. So
Yeah.
that's where you want to have the local conversations. What are you doing here? As an example, I don't think that a lot of buyers right now know that our values went up across the Treasure Valley here about 4.5% in the last year. I think the general perception is values are still going down. We had the correction, post-COVID correction, right? Adjustment, whatever you want to call it, where values came down, and we're already seeing them come back up. So the last year, 4.5%.
Yeah.
Real quick, because I definitely want you to interject there, but let's just put a number on that. Let's just round it to 5 because that's an easier number. On that same $500,000 house, from a year ago, that's a $25,000 more expensive house.
Mm-hmm.
So, you know, did that $500,000 home get pushed out of your budget? I don't know.
So,
Um, Go ahead.
yeah, so Ada County, year over year was, I think, like about 900 closings, right? And so that's up 10% year over year, right? Just the number of sales. We were
Yeah.
lucky in that the median home price at like five, what are we, 549 and some change, I think, right now in Ada County, which I think that was flat year over year,
Yeah. Yeah.
right? So it didn't go down, it didn't, right? And now we're on the cusp of seeing this big change, right? As interest rates trickle down and more demand, and I'm feeling it. I don't know if you are. You obviously you're seeing a lot of people look, but people filling out applications, reaching out, whether it's refinances or purchases. I've seen a massive difference
Mm-hmm.
in the activity
Yeah.
with my clients.
Yeah. Yeah. There was another point too that I really wanted. Oops, sorry. Shoot. It's gonna escape me. It'll come back up in a minute here. So okay. So we're already seeing values tick up. Our buyers really need to know that because again, if your perception is it's going down or going to crash, I, I just think I just think you're there's more hope
Yeah.
than you should put into that.
Yeah, and yeah, because I mean, we've been waiting for it to crash for what, 4 years now, like something like that. It did. They kept saying, and we went through that little recessive period, which we needed, and the monetary policy kind of staved off some of that, which you can have your opinions on whether that's good or bad.
Yeah.
I'm a market guy. Let it live.
Yeah.
Um, but you know, one more point on that, on the rate reduction, is that with what we've seen over the past couple months, your average borrower with like a $3,000 a month budget, they've gained about $20,000 in purchasing power
Yeah.
from what we've seen.
Nice.
Like you're seeing, like, which is great, right? But
Yeah.
like we're seeing that, yeah, activity come up. Now we're seeing that we're going to see, next thing we'll see is inventory levels decrease, and we can get into it. So we could, I mean, I don't know where you want to go from here, but we can get into the actual numbers and what that looks like.
Yeah,
Um,
let's get there in just a couple seconds here. I do want to chat, if we can, a little bit more about inventory and prices, and then give those examples, because I think that's going to be kind of the closing, piece here. But so we're seeing values go up. We're we're anticipating interest rates go down. We've talked about how many buyers that brings into the market. So now, as buyers start coming on, they're gonna gobble up inventory quickly,
yeah,
right? Because we've seen it multiple times. Anytime rates go down, and oh, I remember what I was going to say earlier. So the buyer confidence, we've got a lot of buyers out there, and as the interest rates go down, we're going to have more buyers come in. But also, buyer confidence is going up. We're past the election year.
mm-hmm.
Um, we've got less wars and less, conflicts internationally than we've had before. Um, so a lot of the things that make people pause in buying a home, yeah, the economy's not bulletproof, but all the factors, a lot of them are subsiding, which means more buyers are going to feel better about moving into the market. So rates go down, confidence is already rolling on, and they start buying homes. Okay. So in a low inventory market, inventory is pulling off, values start ticking up even more than the 4.5% that we've seen the last year, potentially.
Yeah, yes,
So anyway, I just wanted to interject that real quick. Do
yeah,
you want to talk specific examples? Is that what you were thinking?
yeah. I obviously we want to, try to keep our time down so we don't bore people to death, right? So, but I want to get through. I think to give actual numbers might be helpful, right?
Hmm.
And this is kind of what I'm talking about, because you have the buy now versus wait. Once interest rates get into the fives, then I can do this. And what we push is, if you can afford to buy now, if you can afford to buy when it's right for you and your family, right?
Yeah.
That's like, we're not saying you have to buy at all costs. If it's right for y'all, right, then
Yeah.
it's time. Then it's time.
Yeah.
And so, if you figure a 30-year fixed mortgage with 20% down on the Idaho median, which is lower than Ada counties. Ada counties, we just gave that number. Idaho is 491. So 20% down. So you're looking at a $392,000, almost $393,000 loan amount, right? Your
Hmm.
principal and interest at 6.5% is 2484. Okay.
Hmm.
Now, if you are to wait for interest rates to go down to 5.5, a full percent, and we'll get into the likelihood of that in a minute.
Hmm.
But you go from 6.5 to 5.5. But as we've discussed now, all that demand has driven home prices up, right? So you're paying $50,000 more for the exact same house, while you've waited for that 5.5%, because it's not going to happen in a month's time,
Right.
right? So the market's going to react to those things, and home prices are going to go up. Loan amount is the same. Now you have a high 5.5% interest rate, but you've paid $50,000 more for your house,
Hmm.
so you're paying 541, and so that monthly payment is 2458.
Mm.
So you went from 2484 to 2458, but you paid $50,000 more for your home, right? instead of buying now and you have $50,000 worth of equity over that increase.
Right. Yeah.
And that doesn't even take into account all of, I mean, and we've beat this horse to death too, right? Like that, all of the availability of seller concessions, or, people, giving interest rate buy downs, or, all of that will have gone away as well as the demand is driving prices up, right? Because
Yeah.
there's no incentive at that point for the seller to give those things anymore.
Yeah. Let's give an example of that, right? So now, yes, their values are going up, but you have sellers. And actually, there was a point. Let me go back to another point here. The other thing that we really need to understand is, if you think that the market is softening or prices are going down, separate reseller new or existing from new construction, right?
Mhm.
Because the new construction days on market are very short. The resale might be long, but they're going to offset each other, and they're going to factor into the same number. So, but they're two kind of different segments of our market.
Yeah.
So I think that's important for folks to know. They're like, hey, I've seen this existing home on the market for a while, but then when I go look at new construction homes, they're flying off the shelf. So you might perceive that the market's slow if you're only looking at existing, but if you look at new construction, they're clipping right along. But what I was going to say is, in either case, with promotions from the builders or concessions from the sellers, which are kind of the same, if you can get them to give you, let's just say, a $10,000 seller concession or builder promotion for your closing cost, that's $10,000 less than you had to come out of your pocket
Yep.
to get a loan. I mean, so now not only did you have $50,000 in equity over that same period of time you talked about, but you kept that 10 grand in your pocket, or you put it towards, appliances or yard or whatever.
Right.
So anyway, was that the extent of kind of the example that you had?
Yeah, yeah. I just want to get down to the numbers, right? Like, just say, hey, payment wise, if you're waiting, right? Whereas you could, you might save 20, $30 a month in payment, if that.
Mm-hmm.
Once you add in mortgage insurance, or if you're putting less than 20% down, or you add insurance, or you add property taxes, then at that point those differences are likely even smaller, right? And so I just wanted to illustrate that the weight doesn't actually necessarily help you. And who wouldn't rather have $50,000 worth of equity in their home, right?
Right.
As opposed to paying that much more for it. And so I think what you save on rate, you could very well lose back on price.
Yeah.
That's
Yeah. Very important thing to note. It's that, timing thing that everybody's trying to juggle.
Yeah,
And we both feel like we're kind of at that lull in pricing. I mean, we're seeing it, right? The last year we went up. So
yeah,
to think that it wouldn't go up next year, with the things like I said, the presidential election gone, wars getting tied up, economy strengthening, why wouldn't values go up? And if they go up at an even faster rate than the 4.5, that just means you've either bought and you're getting equity, or you haven't bought and you're paying more.
yes.
So
Yeah, and I mean, not everybody can afford, right? Like,
right,
that's just
right.
where we're at in some of the economies, around the nation. But if you can, like, waiting isn't necessarily a friend, especially at this point. And we've been preaching this for a year,
Hmm.
right? And we're seeing that stuff come to fruition.
Yep.
Um,
Yeah, it took a little longer than maybe we thought, but it's
yeah, the
happening.
time the timing's hard to judge, and we've been blessed to keep the builder concessions, the seller concessions around this long.
Right.
It's been very helpful for a lot of my buyers, and yours as well. And I just think that we've been blessed to have that. But if you expect that to be a normal market, and $25,000 in concessions from builders to
Yeah.
continue for a long period of time, yeah, yeah,
Yeah.
I wouldn't bet on that. It
Well,
it would be.
well, you made a really good point here, Chase. These seller concessions from the existing homeowners or the builder to pay for your closing costs could be a make or break for some folks. Some folks won't,
Yeah,
and as soon as they go away, they can't buy because they didn't set aside and I'm just using 10,000 as a round number for closing costs. But if you don't have that set aside and you can't get that from the seller, you're not buying a house.
Yeah.
So if you wait too long and now all of a sudden, homeowners or builders aren't giving them, you got priced out by virtue of not because you couldn't afford it, but because you didn't have enough money to put into it. Anyway, so we're just a little bit over 30. We didn't do too bad today. We're like 35. So
Yeah. Yeah. Yeah, I would say, for me, just in closing, like, to summarize everything, the Fed speaks to the bond market as a whole, um, and that translates into mortgages slowly. If we get to a 1%, so every little bit of interest rate that we drop, yes, it does help with affordability, but it invites millions back to the market, so it's increasing your competition,
yeah, yeah.
right?
Love the summary. Love the summary.
Legit. Yep.
And I think an even kind of overarching summary that we always talk about is just call us. There's no obligation. Just let's chat through your personal situation, because right now we're talking about some examples and generalities, but your specific situation is what we'd love to have a conversation around. And we're
Absolutely.
just we treat all of our clients as if they were family or close friends, and we would always advise them as if we would want to be advised. So if it doesn't make sense, it doesn't make sense. And usually
Right.
it doesn't make sense forever. It might not make sense today. Let's get you positioned for later.
Absolutely.
So anyway, well, as always, Chase, I really appreciate you jumping on these and bringing your appraisal expertise and lender expertise to the table. And just I mean, you come from a lot of different perspectives, so I really appreciate you coming on.
No, it's fun. I enjoy it,
So
as
cool,
always.
cool. All right. Other than that, we'll wish everybody a blessed one. Take care.